Today on InvestTalk, we look at what $60 oil will mean for the broader economy. Then we look at the bullish day in markets, and we also answer questions about Micron, ResMed, Synopsys, and more. And at the end, I look at corporate investment trends in China.
This is InvestTalk, independent thinking, shared success.
Now, our main focus point is about oil prices. Oil prices are down into the 60s after for a long period of time, hanging in the $70 to $80 range. And, this is going to have a large impact on markets. Now, oil did bounce back today, but Brent crude fell below $70 a barrel for the first time since late 2021. And there are major banks that are saying we could head into around $60 per barrel. Okay. Sometime next year, you're talking about Citigroup, JP Morgan, and some of the world's largest commodity traders. And there's two ways to look at this. Obviously, from an industry perspective, that means lower profits. So exposure there, and you see that with the relative strength of a lot of those ETFs. Now, I could easily argue that this is actually where you want to buy the energy space, because you have the strategic oil reserve where they're going to refill at these levels, and you also have the frackers and E&P companies that just are not really incentivized to grow production at these prices. They say the cure for higher prices are higher prices, and vice versa. The cure for lower prices are lower prices, because economics went out. And now from an economic perspective, this will certainly actually help the economy. Why? Because the Fed is going to see, this is going to feed into inflation data, and it's going to allow the Fed to ease more than they would have otherwise. In fact, the ECB, they're set to deliver their second rate reduction today. Okay. And they pretty much did that. Okay. And so the Fed is obviously expected to cut rates next week, but what about going forward? To the fact that inflation, will be pushed down because of this, will allow them to promise even more rate cuts going forward. Now, what is driving this? Well, first is the demand side. You have a debt deflationary bust that's happening in China. So that is a big adjustment to overall demand. And our economy here domestically continues to slow, although, not as crazy as it once was. Right? The growth is not as crazy as it once was. Now, adjusted for inflation, oil is now at levels not seen in over 2 decades. Nearly 2 decades. And so that's the demand side. Globally, oil production is up 1.5 million barrels a day this year and next. And so that's surpassing world demand growth by about 50%. So that's also pushing those prices down. Now, once again, if we get a weaker dollar, though, because the Fed can cut rates, that will also buoy oil prices. So I actually think we're getting to a level where oil is becoming more attractive. Oil-related names are becoming fairly attractive again. Now let's take a look at the market today. It was a decidedly positive day overall for equities after the follow through on the back of the inflation data yesterday. And we had another really solid day across the board. Small caps were up nearly 1%. Large caps were up. Let's see, S&P was up 0.75%. NASDAQ was up 1%. The Dow certainly lagged 0.58% there. Broad U.S. market up about 78 basis points. So pretty solid day. And we are heading into kind of the Fed season, right? Fed time of the month. Fed meeting is coming up on September 18th. So that is less than a week. So it's next Wednesday. And there's now a 72% chance that we will only get a 1/4 point cut at that meeting. Now, one thing that's going to be very interesting is not just everyone's focused on whether they're going to cut 25 basis points or 50 basis points. And, it matters to a degree. But what will be more important is what happens with the balance sheet. Remember, they started to wind down QT in, June, I think, timeframe, May, June timeframe. And Well, the question is, will they take that next step and pause it all together and say, okay, we're not winding down our balance sheet anymore? Or do they take another stair step lower and they say, okay, now we're going to cut our QT in half again, for example? And I think that will be something that will be underrated about the potential move from the Fed in next week. And so we're getting into that Fed speak, Fed talk, Fed focus, even though we still have earnings coming out, and we had kind of a mixed bag after hours so far. But overall, it's a market that remains bullish. Despite the seasonality, despite a choppy period that we're in, and we continue to see more chop. I would not shock me to see between now and election time more market volatility. But what you see is that any decent pullback tends to get bought. Any decent pullback tends to turn into just a higher low. And when you have that, you have to understand that the path of least resistance remains to the upside, even if near term there's still a lot of chop. And that's kind of where we're at in markets as we head into Fed week next week.
Hey, this is Jake from Northern California. I'm calling to ask about PSCE, the Invesco SmallCap Energy Fund. I currently own it. It is about 6% of my overall portfolio in a retirement account. I also have some exposure to XLE with my total energy exposure about 20%. I like energy. I'm really just calling to see what you guys think of this small cap fund. I think I remember Luke saying that he liked the larger companies more than the smaller ones. I mainly got into it just to diversify my large and small cap exposure. But if you guys think this is something I should get out of and put it into something like XOP, just for some other diversification, staying with the larger ETFs, that'd be great. Appreciate it. Thank you.
All right. Well, there's definitely something to be said about the larger names that tend to have more scale and do very well kind of generally long term because of that scale, good balance sheets, ability to go buy companies on the cheap when prices are low, like right now. And, that's why they tend to do very well in the long term. Now, the PSCE, those are more small cap names, and there's just going to be more volatility there. So you've seen that on the downside here. And, is XOP a good alternative? Not really, but it is a bit more diversified, okay, than an XLE. One of the big issues with XLE is that the vast majority of that ETF is Exxon and Chevron. Okay, you're talking about 23% in Exxon, 16% in Chevron. So 40% of the portfolio, those two large cap names. Now the XOP, that's going to be more diversified. You still have your Exxons and Chevrons in there, but Exxon is the top holding at only 3%. Okay, and Chevron's down to 2.9%. That's the 9th largest holding. So much more diversified there. I like that. And that's XOP. This is the S&P Oil and Gas Exploration and Production ETF. So getting rid of a lot of those companies that are refining products, for example, oil service companies, for example, just straight up E&P names. And I kind of like that. I like the E&Ps in general. And so I would probably go with that if you want to add a bit more diversity, just because you have the mid caps in there. The small cap names, they tend to be very, very volatile. Now, if you're trying to trade, you're saying, hey, I want the most upside for the next move higher in oil. Well, you're going to want a PSCE over an XLE or an XOP. So from a trading perspective, I'd rather own PSCE. But if you're talking about long-term buy and hold, I would rather own XOP because of that diversification, more mid caps, and still a pretty even distribution across the category. Thanks for the call. Let's go to Mike in Utah. Wants to talk about CSV, Carriage Services, correct?
Yes, Carriage Services. I was actually going to see if we can compare similar. One's SCI and one's CSV. They're both similar companies.
Mm-hmm.
They're kind of high in debt, and one's more of a small cap. The CSV is more of a small cap versus the SCI. And from yesterday's program, he was talking about small caps should benefit from the lowering interest rates, I believe is how he phrased it.
Yep. Yeah, well, they both operate in the funeral business, right? Provide funeral, cremation, cemetery services. At SCI, they have about 1,500 funeral sites and about 500 cemeteries. Let's see, CSV. Yeah, they have funeral homes, 171 funeral homes in 26 states and 32 cemeteries in 11 states. So, yeah, much smaller, only about a $500 million market cap there versus SCI. That one has a market cap of about $11 billion. So you're really, yes, they're in the same business, but they're very different companies in terms of size. CSV's business is doing a bit better in the near term, I will say that. Their growth for this year is expected to be 8% as well as 8% next year, whereas SCI is 2% this year and 11% next year. So you average that out, a little bit slower growth, but also bigger company, right? It's harder to grow when you're a bigger company. But you did say that CSV has a decent amount of debt. Is that correct?
They both have kind of a lot of debt, and I'm guessing because of the funeral, like the cemeteries. I'm guessing the land.
Yeah, I mean it's certainly a capital-intense business, but it looks like Carrier Services debt is much bigger as a percentage. So you're talking about $500 million in debt on net debt on about $500 million market cap, whereas SCI they have about $4.5 billion in net debt and an $11 billion market cap. So percentage-wise, it's about half as much leverage for SCI versus CSV. Profitability, return on equity on SCI is 32% versus 17% for SCV. We actually used to own SCI for clients, so we liked it. We still like it. We just put money into something else. But overall, I would rather just own SCI. You have a better balance sheet. You have better profitability here. You have more diversity in their business, and more scale. And that's probably why they have better profitability. So I probably wouldn't mess with the smaller name. I'd rather go with the larger name. The relative strength is even better. You have SCI at 83 versus CSV is at, they're both 83. So they're about the same on the relative strength perspective, but you just have a much better balance sheet with SCI.
Okay, perfect. That sums it up. Thank you for your help.
No problem. Thanks for the call.
Hey, Justin, Luke, we love your show. Thanks for all the help you've given us over the years. I have a question about what I believe is a mutual fund. It's offered through Schwab. It's called Schwab U.S. Treasury Money Investor, symbol SNSXX, and it looks like it's producing about 5% interest. And what I wanted to find out is how safe this is on a relative level, like a CD versus stock. And looking to lock up some money for about 3 months and wanted to go somewhere a little more stable right now than the S&P 500. So any info you can get would be great. Thank you.
All right, looking at SNSXX. Well, this is the Schwab U.S. Treasury Money Fund. And so as the name implies, they invest in treasuries. So how safe is it? It's extremely safe. It's extremely safe. Okay, you're not going to lose money on this. It's going to pay you a yield. Right now, the 7-day yield is about 4.9%. Now, understand, though, that the Fed will cut rates next week, and that will impact this particular ETF as well. So you'll see, though, that yield drop a bit. I think at Schwab, there are better funds than this, so I would look elsewhere as well. I mean, you're also comparing apples to oranges. You're saying, something safe versus the S&P. S&P's risk, and this is no risk. And so you're talking about locking up money, though, for 3 months. Well, this also wouldn't be locking up money because it's a money market fund. You are, that you can take money out whenever you want. Now, you parking money there for 3 months, that can be fine. But maybe you find a 3-month Treasury. You could probably find a 3-month Treasury better than this. You could find a CD potentially a little bit better than this. Because remember, that rate is going to fall there. So not a bad option by any means, but there might be something a little bit better. But also depends on how much trading you want to do. Right? By going by a Treasury, that can be daunting for people that never done it. So this is simple. It's easy. Probably have Schwab fund or Schwab assets over at Schwab, and you just can go buy this money market fund and earn your 5%, 4.75%, whatever it is over the next few months. And it's extremely safe, so you don't have to worry about that. Hope that helped. And I hope you've been telling your friends about our InvestTalk podcast being available in video form over on YouTube. So we get questions submitted via the comment section there, and we will tackle one of those questions right now. Joe Hughes, 3725 says, thanks for your financial insights each day. What are your thoughts on ResMed? RMD is the symbol. In my industry, when you hear RMD, you think of a required minimum distribution, but not in this case. This is a symbol of ResMed, and it is a large cap name, $37 billion market cap. They develop medical equipment to diagnose, manage sleep disorders, breathing disorders, and mainly sleep apnea. And their business is very quality, very consistent over the years. And from a demographic standpoint, you have a lot of older Americans, a lot of them overweight, and a lot of them have sleep apnea because of that. And so this is one of the largest respiratory care device companies globally. Okay, so this is the play on sleep apnea. And their profitability is very high, 23% return on equity, pretty much no net debt in its balance sheet. Free cash flow about $1.2 billion on a $36 billion market cap. You're talking about roughly a 4% free cash flow yield. That's pretty good. Earnings are supposed to be up 18% this year, 10% next year. Last quarter, revenues were up 9%, earnings were up 30%. So things are looking on the up and up. The dividend yield is only 0.85%, but the relative strength is very high, 95%. So you're talking about a good balance sheet, good profitability, solid growth in a durable sector with good demographic tailwinds. I have to give it a thumbs up, right? I have to give it a thumbs up. Now, this is another perfect example, another lesson, a broader lesson for all of you out there. I'd much rather own this than the vast majority of names that are yielding 4%, 5%, 6%. Because this is probably a better business than most of those names, with better balance sheet than most of those names. So, a lot of people scoff at this, only 0.85%. That's not a yield. Well, they have plenty of ability to raise that dividend because of their balance sheet, the quality of their business, and they have been raising that dividend consistently since 2013, when they paid 17 cents a quarter. Now they're up to 53 cents per quarter. Once again, annualized, it's only about $2 per share on a $250 stock, less than 1%. But guess what? So much room for growth within for that dividend, and most of all, just a great business. So I'm going to give ResMed a thumbs up. Okay. Now let's touch a bit on a recent survey from the European Chamber of Commerce in China and the American Chamber of Commerce in Shanghai. And what it's saying is that many global businesses are pushing China down the list when it comes to their investment destinations, and many times consolidating operations within that country. Now, the poll by U.S. Chamber of Commerce found that percentage of respondents ranking China as their headquarters top investment destination fell to the lowest level in the history of the survey, which began 25 years ago. Now, what's driving these decisions? Well, the economy there slumping, mainly driven by the real estate sector, increasing global and local competition, especially around Asia, Geopolitical tensions, obviously, and the rise of alternative destinations that are just getting better. And so profit margins within China no longer are better than a lot of the alternatives within the region. You have companies like Walmart. They sold an 8-year-old stake in an e-commerce platform in China for $3.6 billion. IBM closed research institutions in China, which laid off over 1,000 workers. So obviously there's an IP worry there, right? Intellectual property worry with IBM. Japan recently suspended production at 3 plants in China when unit sales fell in 32% in the second quarter. Now, last year, foreign investment into China fell 8%. And that is set to continue this year. And what country is benefiting the most? Indonesia. Much smaller population, but drawing a lot of what is called greenfield investments, meaning building facilities from the ground up. That's where a lot of the investment is going. Now, companies aren't abandoning China altogether. It's just about new investments. And a lot of it's consolidating current production and saying, I don't need more, but I'm going to maybe make those facilities more efficient, more effective, etc. Now, the annual survey by the EU Chamber of Commerce saw 15% of respondents said China was their top investment destination. But for years, that was well over 20%. And 20% of those that are surveyed by the American Chamber of Commerce in Shanghai said they were cutting investment in China this year and redirecting that towards India and Vietnam. So Indonesia, India, and Vietnam. And Apple is one of those, right? Sourcing more from India and Vietnam. And a lot of the rivals within the space are improving their technology, their infrastructure, and their ability to produce all types of new products. And so this is a huge shift. And another reason why China's economy, their stock market, continues to just kind of flounder. Even though things look cheap, in many ways, Chinese investments are the ultimate value trap. Now let's play another voice bank question. Remember, you can call anytime, 24/7, and deposit your finance or stock question. And we love those live calls as well at 888-99-CHART.
Hello, I had a call about Gentex. That is the ticker symbol George, Nancy, Tom, Xavier. I believe this was mentioned in one of your stock ideas a couple months back, only because you had mentioned designing mirrors and no debt, long-term or short-term, if I recall correctly. This is starting to hit my price target at just below $29. I'm thinking about buying them. Just wanted to get your opinion, whether or not you think below $29 is good, maybe a good price range. Thank you. Have a wonderful day.
All right, looking at Gentex, and this is a mid-cap name, about a $6 billion, $6.5 billion market cap. Correct, no debt, no long-term debt on the balance sheet. Their return equity is 18%, very, very solid, and kind of near longer-term averages, so that's good. Free cash flow about $400 billion on a market cap of 400 million on a market cap of 6.6 billion. So roughly a 6-7% free cash flow yield there. What are they doing with that cash flow? They're paying a nice 1.5% dividend and they're buying back shares, so that's all positive. But the trends in the stock are not, right? It peaked out about $37 per share back in March. Now we're down to 28 and change. And as usual, you want to line up those fundamentals with the technicals and make sure those technicals are at least neutral to positive. And this is actually fairly bearish near term. And now it is approaching the lows from last month, but I just don't love the price action. So I would continue to keep this on the sidelines. Obviously a good business. We wrote about it, and it's always, and just a disclaimer here with the stock ideas. Those are always ideas. They're things to put on a watch list, not necessarily to buy today. So I think that remains, that continues with this. It's still a quality business, quality balance sheet, good cash flows, obviously good products and management, but the technicals are just too poor to ignore. And so I would wait until there's a better sign of a reversal. And I could easily see this getting back down to the 24 level, which you saw at the bottom in 2022. So I would continue to be patient on Gentex, GNTX. Now let's go and pivot to a live call. Sammy from San Francisco wants to talk about Micron.
Yeah, thanks, Justin, for taking my call. I was wondering if this is a good time to get into Micron.
All right, Micron has pulled back pretty nicely. Was at about $157 per share back in June, and now we're down to $87 per share. Certainly at a good support level on the weekly, and that is near the 100-week moving average, near where the stock broke out back in, when was that? In February of this year. And so I like that round trip there. Now it did go up, I think, a lot because of the AI hype. So it was like most of the AI plays, it was a bit overblown. And earnings this year is supposed to be $1.23 and $9.58 next year. Now, if that's true, obviously the stock is relatively cheap, trading at $87 per share. So what I would say is simply, yes, it's at good support. It's still going to be very volatile because of the AI play, because of the semiconductor space that tends to be fairly cyclical. So it's high risk, right? It's very high risk still, but they have a good balance sheet and it's at major support. So if you think the economy will reaccelerate to the upside heading into next year, then this would be a good play on that. Now, here's another question from our InvestTalk YouTube channel. Matthew Bird says, I wonder if you could look at SNPS, maybe speak to what kind of premium a company like this might merit in your view, given its fundamental importance and even defensive nature of its revenues in the semiconductor down cycle. Looking at SNPS, and this is Synopsys, and this is a very quality company. Earnings expect to be up 23% this year, 14% next year. But as the commenter said, it is trading at a pretty nice premium. And what it does is provide electronic design, automation, software, intellectual property, and software integrity products. So it helps with the chip design process. And in order to do that, they have extracted some nice cash flow, about $1 billion in free cash flow trailing 12 months on a $75 billion market cap. That's pretty low yield, right? You're talking about a 1.5% free cash flow yield. That's fairly expensive. Price to sales ratio about 11.5. That's also pretty expensive. Now the return on equity is 22%. That's good. Not amazing, but good. Okay. And no dividend here. What are they doing with that cash flow? They're not buying back shares or issuing. So kind of neutral on that side when it comes to returning capital to shareholders. Pretty much no debt, about $3 billion in net debt on its balance sheet. So that's good. But it's trading at a pretty hefty premium here. And if you look at enterprise value to EBITDA, we're at 38, forward-looking 27. You go back in history, and this typically doesn't get cheap until you're closer to the teens in an enterprise value to EBITDA. And that's why I would be patient on this. I just think it's too expensive. Would I pay a premium? Yes, but I want a multiple enterprise value to EBITDA, in the high teens. That would be interesting to me. Okay, so I think there's a lot of work to do. I would continue to monitor it, but for now, I'd keep it on the sidelines. Thanks for the call.
This is Randy in Tampa, Florida. Thank you for all you do. Been a long-time listener, recommended to a lot of people. I wanted to see what your thoughts are on ticker symbol COWZ, COWZ. It's an ETF, free cash flow ETF. Just want to get your opinion on it. Thank you so much for all you do. Look forward to hearing my question on the program. Bye-bye.
All right, looking at the Pacer US Cash COWZ 100 ETF. And this is a very interesting name because it focuses on cash flow, right? and companies that produce strong cash flow. So the top holding is 3M, then Gilead Sciences, AT&T, Bristol Myers, Lennar, Altria, etc. And the industry breakdown is fairly different than the S&P. There's no financial services here, no real estate, no utilities, but 21% consumer cyclical, 16% energy, 12% industrials, 18% technology, etc. Now, I like the focus on free cash flow. We focus on that as well, amongst other things. And I think that's where my issue is what are those other things, other multiples? And if you look at things like price to cash flow, it trades at about 7 times price to cash flow. So that's lower than the category average, but it's not necessarily low. Price to book is actually a bit higher than the category average and the broader index, but it does trade at a lower PE ratio. So that's good. If you look at free cash flow growth, it's much better, about 16% versus the category average, about 9.5%. So I'm liking a lot. I'm liking some of it, but it's a step up, I think, from your S&P 500, for example, and it's mainly a mid-cap value ETF. That's kind of what this is. And so if you're looking for mid-cap value exposure, this is a good way to get it, although not perfect. Thanks for the call. Now, let's touch a bit on industrial policy. And this is huge, something that is a big, big trend. And, a lot of people thought when Trump left the White House, the Biden administration would come in, he'd be less abrasive towards trade in China. But the reality has actually been very, very different. Okay, in the past 3 years, the Biden administration has gone much further by linking economic security to national security. And this is a trend that I think is worrying not just China, but the rest of the world. Okay, and President Biden, the White House currently is planning a 25% tariff on imports of Chinese-produced cranes that will that typically dominate the container unloading business at American ports. And it's all about the worry that these cranes will have espionage software that will allow their military to monitor military-related shipments. And so this is one example of a seismic change in American economic thinking. And over the past decades, there's been a much greater willingness to use tariffs and as part of industrial and trade policy, and in parallel with some sort of state intervention to boost investment in certain key sectors. That's what the CHIPS Act was about, the Inflation Reduction Act was about. And this is all being turbocharged with a backdrop of entrenched worries about national security. That every industry that they come across, that there's some way to spin it that, hey, we're doing this because of national security. And that is coloring the economic growth and the industries that are where money is being deployed. And I think this is only going to continue, and it's not going to change whether it's Trump or Harris in the White House. It's just, the color of how that is going to be implemented. What sectors they're gonna focus on. But pretty much every sector now is being colored with, hey, this is a national security interest. And, in probably some instances it is, and others it's probably overblown. And so this is something to continue to follow and understand that it's allowing whatever administration is in power to really dial in their policy with this veneer of national security interest, and something to continue to monitor. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. Be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.